There's a phrase you've probably heard more times than you can count, especially when markets start shaking, headlines turn red, and policymakers step up to calm the storm. Today's action will protect the retirement security of millions. It sounds reassuring, responsible even, like someone somewhere is watching your back. But if you pause for just a moment and really sit with that statement, you begin to notice something unsettling. Why does retirement need protecting from the very system it depends on? Because beneath that comforting language lies a quiet truth. The modern retirement system isn't just fragile, it's deeply conflicted. And in many ways, it's been quietly reshaped into something very different from what most people think it is. A promise that changed without warning. For decades, retirement followed a simple, almost comforting formula. You worked hard, you showed up, you built a career. And in return, three pillars stood beneath you: Social Security, a company pension, your personal savings. That structure wasn't perfect, but it had something incredibly valuable: certainty. Your employer bore responsibility. Your pension was a promise, not a probability. And Social Security had already proven itself through war, recession, and recovery. Then, slowly, almost invisibly, that system changed. By 1980, about 60% of private sector workers with retirement plans had defined benefit pensions. Today, that number has fallen below 15%. In its place, something else emerged, not a guarantee, not a promise, but a bet. The rise of the 401k, control or transfer of risk. The modern retirement system revolves around accounts like the 401k, IRA, 403b, and others. On the surface, they seem empowering. You contribute, you invest, you grow your wealth, you take control. But there's one critical detail that often gets overlooked. These are defined contribution plans. They define what you put in, they do not define what you get out. What you retire with isn't guaranteed. It's determined by market performance at the exact moment you need it most. And that shift from certainty to uncertainty wasn't accidental. The 401k itself started as a minor provision in the 1978 tax code. It wasn't designed to replace pensions. It was meant as a niche benefit for executives. But companies quickly realized something powerful. It was cheaper. It shifted risk away from them, and it could be marketed as freedom. So it spread, and over time, it became the default. $49 trillion and counting today, retirement accounts have grown into something enormous. By the end of 2025, Americans held roughly $49 trillion in retirement savings. That's not just a statistic, it's a force. It's capital on a scale comparable to the entire housing market. And here's where things start to get complicated. Because when you have that much money locked away, long-term, and politically sensitive, it doesn't just sit quietly, it becomes useful. The perfect investor nobody talks about. From Wall Street's perspective, retirement accounts are almost ideal. Think about it. The money stays invested for decades. Withdrawals are discouraged with penalties. Investors rarely move funds quickly. Most people don't closely monitor what they're invested in. In other words, retirement savers are patient, predictable, massive in scale, and often unaware. That combination creates something incredibly valuable for the financial system: a captive pool of capital. And that pool doesn't just invest in simple, transparent assets anymore. It increasingly flows into private equity, private credit complex real estate structures, illiquid financial products. Why? Because these assets benefit from long timelines and limited scrutiny. And retirement money provides exactly that. When things go wrong, who holds the risk? Here's where the story takes a turn. When risky investments start to wobble, the system doesn't simply let them fail. Instead, something familiar happens: intervention, liquidity support, regulatory flexibility, emergency measures, and the justification is almost always the same. We have to protect people's retirement. That phrase carries weight, emotional weight, political weight, but it also creates a powerful shield. Because once retirement is tied to financial markets, every market problem becomes a retirement problem, and that makes it very difficult to let anything fail. The quiet shift in responsibility. What's remarkable is how this system presents itself. It tells you you're in control, you're building your future, you're participating in growth. And all of that is partially true. But at the same time, it quietly places the burden of uncertainty squarely on your shoulders. You take the risk. But when things go wrong, the system steps in, not necessarily to protect you individually, but to stabilize the broader structure your savings are tied to. That's a subtle but important distinction. Who really benefits? There's another layer to this story, one that's harder to see but impossible to ignore once you notice it. Retirement accounts are often framed as a universal safety net, but in reality, they are not evenly distributed. Data consistently shows that the top 10% of households hold the majority of retirement assets. The top 1% alone holds more than the bottom half combined. Meanwhile, many households have little to no retirement savings at all. So when policies are justified as protecting people's retirement, it's worth asking, which people? Because in many cases, the benefits skew toward those who are already financially secure. The hidden cost of tax advantages. Retirement accounts come with tax benefits, and those benefits are substantial. In 2025 alone, retirement-related tax breaks cost the U.S. government approximately $383 billion. That's not money spent, it's revenue not collected. And while tax incentives are meant to encourage saving, they scale with income, which means the more you earn, the more you can contribute, the more you benefit. So a system designed to help everyone save ends up disproportionately rewarding those who need it least. And then there are the fees. Behind the scenes, another force is quietly at work. Fees. Managing retirement assets isn't free, and collectively, those costs add up. Estimates suggest that tens of billions of dollars each year flow to financial institutions managing these accounts. That's money that doesn't go toward retirement income. It goes toward maintaining the machinery around it. And while each individual fee might seem small, over decades, they compound, just like returns do. The core contradiction. At the heart of all this is a contradiction that's hard to ignore. The system says, you are responsible for your financial future. You must take investment risk. You will be rewarded for that risk. But in practice, risk is often socialized when things go wrong. Policies are shaped to protect markets tied to retirement, and the outcomes are unevenly distributed. It's not purely a free market system, and it's not purely a guaranteed system. It's something in between. A global perspective, it could be worse. Interestingly, the US isn't even the most extreme example of this model. Take Australia. Australia has a mandatory retirement system called superannuation, where workers are required to contribute a portion of their income into investment accounts. It has created one of the largest pools of retirement capital per capita in the world, massive investment influence across the economy, but it has also contributed to unintended consequences. For example, significant portions of that capital flow into housing markets, which has helped drive property prices to extreme levels. In some cases, retirement savings are not just funding the economy, they're reshaping it. So, what does this mean for you? At this point, it might sound like the entire system is broken beyond repair. That's not quite true. Saving and investing for retirement is still essential. If you have the ability to contribute to a 401k, IRA, or similar, you absolutely should. It builds discipline, it creates optionality, it gives you a measure of independence. But it's equally important to understand what the system is and what it isn't. It is not a guarantee, it is not evenly structured, and it does not operate purely in your individual interest. A more honest way to think about retirement. Instead of viewing retirement accounts as a complete solution, it may be more useful to see them as one piece of a larger strategy, a tool, not a promise. Because ultimately, retirement security doesn't come from a single account. It comes from flexibility, awareness, diversification, and realistic expectations. The uncomfortable truth. The system wasn't necessarily designed to fail you, but it also wasn't designed solely to protect you. It evolved piece by piece through incentives, policy decisions, and market forces. And along the way, it became something far more complex than the simple promise it replaced. Where this leaves us. There are solutions, at least on paper, limiting high-risk assets in retirement accounts, adjusting tax benefits to be more equitable, reducing reliance on market performance alone. But implementing those changes is difficult because every part of the current system is deeply interconnected, and any attempt to change it runs into the same argument. What about people's retirement? Retirement, at its core, is about something deeply human. It's about dignity, about rest after decades of effort, about having the freedom to live without constant financial anxiety. The tragedy isn't that we've built a system around markets, it's that we've allowed that system to become so complex and so conflicted that it often works against the very people it was meant to serve. When protection becomes a justification for everything, there's a pattern that starts to emerge once you really understand how deeply retirement savings are tied into the broader financial system. Whenever something begins to crack, whether it's a credit market, a housing segment, or a new financial product that didn't quite live up to expectations, the response is rarely neutral. It's protective, not just of the system itself, but of the narrative around it. Because once you connect everyday people's futures to the performance of financial markets, you create a powerful incentive to defend those markets at almost any cost. And that's exactly what has happened. Policies that might otherwise face strong resistance, looser regulations, bailouts, emergency interventions, suddenly gain a new layer of justification. If we don't act, people could lose their retirement savings. It's not that the statement is false, it's that it becomes too effective. It shuts down debate, it reframes risk as necessity, and it quietly shifts the boundaries of what's considered acceptable. The subtle trade-off nobody talks about. Here's the uncomfortable part. Over the past few decades, we've seen corporate profits reach record highs, asset prices surge, financial markets become more dominant than ever. At the same time, wages for many workers have stagnated, housing affordability has deteriorated, healthcare costs have climbed relentlessly, and whenever meaningful reform is proposed, whether it's stronger worker protections, tighter financial regulation, or policies aimed at making basic necessities more affordable, the same argument tends to surface. We have to be careful. This could hurt markets, and that could hurt retirement accounts. It's a powerful feedback loop because it ties everyday well-being to market performance in a way that makes any disruption feel dangerous, even if that disruption might improve long-term outcomes. The illusion of alignment. One of the most persuasive ideas behind modern retirement investing is that it aligns your interests with the broader economy. If companies do well, your retirement account grows. If markets rise, your future improves. It sounds logical, but alignment isn't always as clean as it appears, because what benefits markets in the short term doesn't always benefit people in the long term. For example, a company cutting costs might boost its stock price, but that could mean layoffs. Rising housing prices might increase investment returns, but make homeownership harder. Financial innovation might generate higher yields, but introduce hidden risks. So while you are technically an investor, your lived experience as a worker, consumer, or homeowner can move in the opposite direction, and that creates tension. What happens when everyone becomes an investor? There's a deeper philosophical shift at play here, one that's easy to miss. Over time, people have been encouraged to see themselves not just as workers or citizens, but as investors first. And that shift changes how policies are framed. Instead of asking, does this improve quality of life? The question becomes, does this support market stability? Instead of focusing on affordable housing, accessible healthcare fare, wages, the focus shifts toward asset prices, market returns, investment performance, because those are the levers that now drive retirement outcomes. The system isn't evil, but it isn't neutral either. It's important to be clear here. This isn't about villains or conspiracies. The system didn't evolve this way because of a single decision or a hidden agenda. It evolved because companies sought to reduce costs, governments encouraged personal responsibility, financial institutions expanded opportunities, individuals embraced the promise of growth. Each step made sense in isolation, but together they created something far more complicated. A system where risk is distributed unevenly, rewards are concentrated, and stability is maintained through intervention. So, what can you actually do? At this point, you might be wondering, if the system has all these issues, what am I supposed to do about it? The answer isn't to opt out entirely. That would be unrealistic and, in many cases, harmful. Instead, it's about approaching retirement with a clearer, more grounded perspective. 1. Use the system, but don't rely on it blindly. If you have access to retirement accounts, use them. Take advantage of employer matches, tax benefits, long-term compounding, but recognize that these are tools, not guarantees. 2. Understand what you're invested. Many people contribute regularly without ever looking under the hood, but your future depends on those investments. Ask questions like, what assets am I exposed to? How liquid are they? What risks am I taking on? Awareness alone can dramatically change your decision-making. 3. Diversify beyond just one system. Retirement security doesn't have to come from a single source. It can include personal investments, real assets, skills, and earning flexibility, even geographic or lifestyle choices. The more diversified your approach, the less dependent you are on any one system working perfectly. 4. Plan for imperfection. The biggest mistake people make is assuming things will go exactly as planned. Markets will fluctuate, policies will change, unexpected events will happen. Building flexibility into your plans isn't pessimistic, it's practical. A different way to think about retirement. Maybe the most important shift is this. Instead of seeing retirement as a fixed destination, something you arrive at once, everything goes right. Think of it as a range of possibilities, a spectrum. Where financial independence can take different forms. Work can evolve rather than stop completely. Security can come from multiple layers, not just one account. Because the more rigid your expectations, the more vulnerable you are to a system that doesn't guarantee outcomes. Why this conversation matters. At first glance, this might all seem abstract, like a macroeconomic discussion that doesn't directly affect your day-to-day life. But it does, because the decisions made within this system shape the opportunities available to you, the risks you're exposed to, and the level of control you actually have over your future. Understanding that doesn't just make you more informed, it makes you more prepared. The emotional reality behind the numbers. Beyond all the charts, statistics, and policy debates, there's something deeply personal at stake here. Retirement isn't just about money. It's about peace of mind, freedom from uncertainty, the ability to choose how you spend your time. And when a system promises those things but delivers them unevenly, it creates a quiet kind of anxiety, one that doesn't always show up in headlines but is felt in everyday decisions. So where does all of this leave us? Not in a place of hopelessness, but in a place of clarity. The modern retirement system is powerful, complex, and imperfect. It offers opportunities, but also carries risks that aren't always obvious. It can work well, but not equally for everyone. And it can provide security, but not certainty. If there's one thing to take away, it's this: you are not just a participant in this system, you are also navigating it. And the more you understand how it actually works, the incentives, the trade offs, the hidden dynamics, the better equipped you are to make decisions that truly serve you, not just in theory, but in reality. For years, people were told, work hard, save consistently, invest wisely, and everything will take care of itself. And while there's truth in that, it's no longer the full story. Because today, building a secure future isn't just about doing the right things. It's about understanding the system those actions exist within. And once you see that system clearly, once you recognize both its strengths and its limitations, you move from being a passive participant to someone who can navigate it with intention, with awareness, and with a level of confidence that doesn't come from blind trust, but from real understanding.